This is going to sound a little off when I mention this idea, but what I would like to consider is bringing a couple of subject matter experts in to talk about a specific tax regulation that's going to take effect at the end of the year.
So we're going to have an episode based on a tax regulation.
Well, first of all, it's a huge issue. When you talk to the estate planning attorneys and so forth, they haven't seen anything like this in decades in terms of the impact on family business owners. This has to do with transferring assets to the next generation that are related to the equity in the business that they've built over the years. And the penalties that they'll end up paying for not taking action in the next couple of months are significant. Depending on how the election falls and how the regulation, if the regulation is finalized at a December 4th hearing, it could impact up to 90% of the family business owners in the United States.
This is Todd McLeese, and welcome to a special episode of the Growth Minded Podcast. You know, usually our show is focused on founders, entrepreneurs, and subject matter experts who have cracked the code on what it takes to successfully grow a company at scale. With this episode, we're going in a different direction because I was recently made aware of an issue that could impact as many as 90% of the family-owned businesses in the U.S. And I happen to know two experts. Jeff Billings is a partner at the law firm of Godfrey & Kahn, and Jamie Rappis is a principal in the national tax practice at Clifton Larson Allen. Both of them have been building successful practices in family business tax and estate planning for the last 25 years. I invited them to come into the Growth Minded Studios and talk about the extraordinary impact this new tax regulation, referred to as Section 2704, might have. If you own a family business, there's a lot of value in the information they share during the next 20 minutes, so let's jump into the conversation. Help us understand what Section 2704 is all about and who's affected by it.
Well, the 2704 regulations came to be in 1990, and they were really aimed at effectively limiting the discounts that family members could take in transferring interests in a family limited partnership or another type of family investment entity from one generation to the next.
What do you think a ramification is, especially given the regulation? Especially given 2704, what kind of a percentage difference are we talking about in terms of tax?
If you want to take advantage of discounts, most people are saying that you got to do it before these regs go final. To that end, we already talked about in December, the first week of December, IRS is going to have a hearing on this issue. So from right now until the first week of December, everybody's providing comments on this, and there's going to be a lot of comments because this is a big deal. Once they have those comments, they'll have a hearing to discuss this. Once they have that hearing, they'll eventually finalize the regulations. Once those regulations become final, that's the point at which you can no longer take advantage of these discounts.
To just put some hard numbers around it, Todd, you know, if we have a $20 million business and we give away 10%, the $2 million transfer today, we can discount that to maybe $1.2 million, let's say. So that $800,000 of value disappears. You know, we'd save, at a minimum, we'd save 40% of that number. After the first of the year, if these regulations go through, that discount essentially goes away. So you're now paying the tax on that discount of 40% or something like that. So it's the real number.
Sounds like there's some pretty serious discussions with regard to control in the family. If in the instance that I have to make a one-time significant transfer, if I decide to go that route, can I still structure so I've got voting shares, et cetera? All of that is still doable in this one-time event as well, right?
Yes.
Yeah, the point is keep control, give away a minority position in the business that's non-voting, get the discounts before this goes final, and take advantage of the opportunity. You're still in control. You're still running your business. You're just hopefully setting your family up for a large tax savings.
We talked a little bit about the fact that this has been around for 30 years or so, and they've taken a couple of swings at it. 2012 seems to be the most recent one. What does that timeline look like over the 30 years? I'm going back a little bit, but
so from a history perspective, as Jamie mentioned, the regs were first passed in the 1990s, and at that time they were attempting to really get after discounts for family businesses. Since the 1990s, there was a series of court cases in the tax court where IRS would argue, you're a family business, you made a transfer, you have certain restrictions that are in your operating agreement that are generating these discounts artificially. We're not going to give you those discounts. Taxpayer fought that in court, and the tax courts were incredibly favorable towards taxpayers. In almost every single tax case that was well litigated, the tax court decided in favor of the taxpayer against the 2704 regs. And that's what's frustrated IRS for the last 30 years. They went to Congress and said, Congress, we need some help on this issue. Legislative action could have solved this issue. Congress could have passed a new law that says no discounts. Right. Congress was not interested in doing that for a variety of reasons. Mm-hmm. So they used the IRS's authority, broad general authority under the regulations, to enforce these regulations, to come up with new regulations to try to combat this problem.
Right. I mean, this is to just point, he's sort of alluding to, the family limited partnerships, the flip planning that really was aggressively pursued in the 90s by estate planners, where we were getting 55, 60% discounts on family limited partnerships. And this is when I was with the service, and it was driving us crazy because we all knew that, these were artificial discounts. It was really 10% of $1 million should be $100,000. It shouldn't be $30,000. So, But the IRS kept fighting this in tax court, and they kept losing. So expanding these regulations would have been timely if they were done in the late 90s and early 2000s. But there's been so much case law around family limited partnerships, and the tax court has really honed in what you need to have substantial discounts or legitimate discounts in a family limited partnership situation. Where arguably we don't need these regulations anymore, and the IRS has gone very hard line on saying, okay, basically no discounts for FLPs, and they've caught in this vast net, operating businesses. I have a widget company where it's a very different animal than a family limited partnership that's marketable securities.
So this speaks to the point that there was the perspective that a lot of this had to do with dealing with the abusers of the law, right? But now it's a much broader regulation, right? Can you talk a little bit further about that? I think you were starting down that path.
Right, yeah. I mean, the FLP situation is a family limited partnership where mom and dad put a marketable security portfolio into a partnership entity, let's say it's $10 million, and then start bringing their kids in at these discounted values for transfer tax purposes, and that's what was driving the IRS crazy. That's a very different scenario than, mom and dad, manufacturing company that's making widgets and actually has production and they're operating a business. That's a very different animal. And I think even the IRS case law would lend itself to say those types of operating businesses, discounts in those situations are fine because it's hard to find a buyer minority interest in a manufacturing company. So I think the IRS is really focused on the abusers that set up these investment partnerships, but they've sort of caught up every partnership, LLC, corporation, anything that is basically a corporate-owned structure is now subject to these regulations.
Any type of entity, and are there other discounts other than those that we've talked about in terms of the valuation and so forth? I mean, what are what's the range of discounts that people are taking that are affected by 2704?
Well, at a high level, the two discounts you hear a lot of are lack of control, inability. So in Jamie's example, we've got a $10 million family limited partnership. Mom and dad gift away 10% to their two kids. The kids actually own limited partnership interests. And the limited partner says if you only own 10%, you don't have majority control. You can't force liquidation. You can't force sale. You can't do anything, basically. And it was a way to keep the kids in line with respect to the gifts, frankly. And so lack of control means you can't control the entity, and therefore it's worth less. That's a basic discount that's under attack by the 2704 regulations. And what IRS has done is basically said, we don't care. If this is a family situation and at least 80 to 90% of the entity is controlled by family members, you can't get that discount anymore. The second discount that we oftentimes see is a marketability or minority discount. So marketability discount has to do with the fact that this is a private company. So I can go out and buy any stock in Google or Amazon or Apple. I know exactly what it's worth. I got willing buy and willing sellers. Private companies don't have that. I can't go to my neighbor and say, hey, do you want to buy 5% of my company? They could buy it, but the price is the hard point. Mm-hmm. And so oftentimes marketability discounts are in the nature of maybe a 5 to 10%, whereas lack of control is where the rest of it is. You could take a 25, 35% discount on lack of control. So appraisers and valuation experts and families would layer these discounts to try to create a total discount of 25 to 50% using these different discounts.
Yeah, in fact, the IRS regulations, the new ones, now say that in that 10% case, you are to value that as if you have a put right. So at any time, you can liquidate that interest and pull 10% of the value out of the entity, which if that were the case, obviously there would be not much of a discount because sure, I'll take that 10% and cash it in right away.
Right.
But that's not reality.
Right.
You know, that's why the appraisers are up in arms, because that's a hypothetical, and that doesn't conform to their standards.
The IRS mentions the use of a bright line test in the regulations.
There's a couple different bright line tests, I believe, in the regulations. This doesn't apply to every single entity in the world. It applies to family entities that are family controlled. And IRS has a bunch of complicated rules to aggregate what's family. But at the end of the day, they have a couple bright line tests that say, I guess the best way to describe this as an example is that a lot of times to generate more discounts and try to get fair market value down, families would oftentimes give away small percentages or nominal percentages in their businesses to charity or to non-family members. And they use those non-family members to help justify some of the discounts. So IRS put a bright line test in that says that if you or your family control more than 10% or 20% of this entity, can't do that. That's a bright line test. There's no facts and circumstances. There's no look at the individual business, the specific situation, the partnership. It doesn't matter. It's just a bright line test. So that's one of the ones that's in the regs right now.
Right, and the attribution rules that Jeff has alluded to, that is a significant change. I mean, right now, if my brother and I own 50% each of a family limited partnership, let's say, the rules say that neither one of us have control. So we can get those kind of discounts that we've been talking about. We can give a lack of control discount. We can have a minority interest discount. So bring that value down by 30 or 40%. Under the new rules, we both have control because our interests are aggregated together. So that's a huge difference.
Just to put this in perspective, during your careers, I mean, where does this fit in terms of the significance of a new regulation coming into being enforced?
I would say that if the regulations get finalized as drafted or similar to as drafted, this is probably the biggest change in terms of business planning for my clients that I've seen. And I think many of the practitioners in my office would say the same thing. We've seen changes in the amount you can leave at death without paying estate tax. We've seen changes in the gift tax laws. We've seen changes in the income tax laws. But for business owners, this is the biggest change I've seen in 50 years.
Right, coupled with the change in 2012 where the exemption was permanently fixed at $5 million and indexed for inflation. I mean, those two are probably the biggest seismic events in the estate planning area for business owners that in my career for sure.
And we're in the midst of an election cycle, so that $5 million's in question as well right now, right?
Hillary Clinton's proposal on the estate tax is actually to drop the exemption from a little over $5 million back down to $3.5 million. And that's for the estate tax. On the gift tax side, she actually wants to restrict it to $1 million per person. Now, all of a sudden, these regulations touch 90% of business owners. Mm-hmm. And so the election, the possibility of the Democrats taking both the Senate and the presidency, coupled with these regulations, is creating a real environment of fear among some business owners.
Let's talk through the timeline just a little bit. How long has 2704 been on your radar in terms of this year? And boy, January 1 seems likely and so forth. How long have you been talking to your clients about this?
This is very fresh. It's a matter of weeks. Now, we've heard rumors for probably 4 or 5 years that these regs were in the can, so to speak, at Treasury, and just we'd hear they were going to come out. So it was sort of a boy cried wolf situation. Mm-hmm. And then they just came out in August here. So
I guess the disadvantage is the hearings first week of December, as you mentioned, Jeff. We're in a period where there are comments being collected and lots of them, but I can't wait till December 4th, right? So what's the recommendation at this point in terms of what I can be doing to protect myself between now and the end of the year?
I think this is an opportunity for family-owned businesses. If you've been thinking about these issues, if you've been worried about taxes, if you've been worried about succession planning, use this as your opportunity to have a conversation with someone who understands this stuff. And maybe you won't do anything, but you'll get a greater appreciation for what's going on, why it matters. And if you do something, you can end up saving your family a lot of money.
Right. Often you hear from the senior generation that they don't know even how to start this conversation, not only with their advisors, but with their children, if that's where the business is going.
Of course, yeah. It's intimidating.
It's intimidating. So this gives them a concrete reason to have that conversation. Look, son and daughter, we need to talk about the transfer of the business because the IRS just put in new regulations that really hamstring our options. So we need to have this discussion. So that's our message to our clients is let's have those discussions.
I've already talked to a few appraisers and valuation groups. They are already starting to get busy, and there's only so much work that those valuation companies can do before the December, before the end of the year. So if you sit around and wait till October, November to start having these conversations, you might find yourself in a situation where you're ready to go. You want to make the gift, everything makes sense, but you can't get the company to value it. And we saw that in 2012. Right. There were valuation companies turning away work because at the end of the year because they didn't have the time.
So that covers some of the key issues related to Section 2704 of the tax code. If you haven't put a plan in place to take action, you should talk to your professional tax advisor. If you'd like to reach out to Jeff Billings at Godfrey & Kahn or Jamie Rappis at Clifton Larson Allen, you can do so by taking a look at the contact information on the screen. If you're listening to the audio-only version of the show, all of that information will be in the show notes, and those are always available at growthminded.io. In the next episode of the Growth Minded podcast, we visit with perhaps the most prolific early-stage investor in Wisconsin. George Mosier joins us, and that's a show you won't want to miss. Until then, thanks for listening.